Welcome to this explainer. You know, we often assume wealth is all about complex financial engineering, secret insider knowledge, or making these high-risk, crazy bets. But the math of persistent compounding, it actually tells a completely different story. The reality is that building real, significant capital over time relies way more on your daily habits and just sticking to a system rather than raw intellect or perfectly timing the market. Let's look at two guys, Ethan and Michael. They start out with the exact same baseline. Same company, same salary, same initial capital. But Ethan kind of falls victim to lifestyle creep. Every time he gets a raise, he spends it. He maxes out his standard of living, leaving literally zero margin at the end of the month. Michael, on the other hand, sets up an automated, systematic investment strategy. Just by putting a small, manageable amount of money into the market every single month, he completely changes his financial future. So fast forward 30 years. One of these guys is super worried about his retirement and running out of money, while the other is completely secure and financially independent. So what made the difference? Was it just pure luck? Did one of them make some genius speculative trades, inherit a bunch of money? Or was this massive gap in their net worth driven by something entirely different? Section 1. The first paycheck. Flashback to age 23. While his friends were out upgrading their apartments and cars, Michael wrote down a core rule in his notebook: pay yourself first. Before spending a single dime on anything else, he moved a slice of his paycheck straight into investments. A lot of his peers thought the amount was way too small to actually matter. But Michael? He was playing the long game. He was relying on the absolute mathematical certainty of long-term growth over short-term spending. Section 2. Unseen progress and patience. Early on, Michael's grandfather gave him this great piece of advice. He pointed to a bamboo plant and said, "Good investments can feel similar. You don't always see results immediately." And it's so true. Bamboo literally spends years building this massive, deep root system underground before you ever see it shoot up. Your portfolio works the exact same way. Those first few years require constant feeding with almost nothing to show for it, which really tests your patience before that exponential growth finally kicks in. When you're just starting out, it honestly feels like you're fighting math. Your contributions are way bigger than your returns, and it can feel like you're just throwing cash into a black hole. But remember, you are building that root system. To get through this phase, you absolutely need discipline. You have to ignore the urge to see instant results. Unseen progress is still happening, and the growth will eventually be exponential, but that initial flatline demands total patience. Section 3. Weathering the financial storms. Of course, the market isn't always sunny. When the economy gets rocky and headlines are screaming about a recession, it's a huge stress test. Ethan tries to time the market. He panics, sells everything when it's down, and then ends up buying back in when prices are high again. It's like waiting for a broken elevator. Meanwhile, Michael just takes the stairs. He uses simple dollar-cost averaging, continuously buying in no matter what the news says. This keeps him perfectly positioned to catch the inevitable recovery. But what happens when the storm isn't on Wall Street, but in your own living room? Because eventually, life happens to all of us. Theory is great until it crashes into reality. And out of nowhere, Michael gets hit with an unexpected layoff. When a personal crisis like a job loss hits, a lot of people panic. They end up cashing out their retirement accounts just to pay rent, which completely derails their compounding, like literally abandoning the ship. But Michael had built an emergency fund years ago. That cash buffer meant he didn't have to touch his investments. He just adjusted his sales, weathered the storm, and protected his long-term wealth from being totally wiped out. The real takeaway here is that being consistent doesn't mean you'll somehow magically avoid life's problems. That's impossible. Consistency means making sure a temporary setback doesn't permanently ruin your long-term plan. You lean on your emergency savings, you hold your ground, and the second the storm passes, you get right back to investing. Section 4. The power of consistency. You know, a lot of people want quick wins. They want to plant weekend flowers that look pretty right away but die a week later. Michael, though, spent his life planting an orchard. He knew it would be slow going at first, and yeah, maybe a few trees wouldn't make it. But over the decades, those initial seeds grew into this massive, diversified ecosystem that literally feeds him year after year without him having to lift a finger. Let's look back at this whole 35-year timeline. From that very first paycheck deduction, learning the bamboo lesson, surviving market crashes and a job loss, all the way to retirement. Notice what's missing here. There's no winning lottery ticket, no secret windfall, no inside trading advantage. It's literally just time in the market, having a cash buffer, and an unbreakable, stubborn consistency. So when Michael finally hits financial independence, Ethan, who is still stressed and trying to game the system, finally asks him. He just looks at him and says, "So what was the secret?" He is convinced there has to be some hidden trick that explains why Michael is so far ahead. But Michael didn't have a secret algorithm. He didn't have a magical trading app. He just opened up that same worn-out notebook from when he was 23, pointed right to that very first rule he wrote down, and said the ultimate testament to compound interest. I just never stopped. We can really boil Michael's entire strategy down to these 5 simple habits. 1. Automate your investments so you don't even have to think about it. 2. Stay patient and accept that market drops are completely normal. 3. Keep learning and understand the fundamentals. 4. Maintain an emergency fund so you're never forced to sell. And 5. Keep your emotions entirely out of your money decisions. Now, we do have to be real here. Investing obviously involves risk. The market will drop sometimes, and returns are never guaranteed. Not every single thing you buy is going to be a winner. But the data shows us time and time again that winning long-term isn't about predicting the future. It's about disciplined habits and giving your money the time it needs to grow. Because true wealth is almost never about one single genius move. It's the compounding result of thousands of ordinary, boring decisions repeated over decades. So, I'll leave you with this. Are you going to spend your life waiting around for the perfect investment setup? Or are you just going to start, build the habit, and refuse to quit? Thanks for joining me on this explainer, and I'll see you on the next one.